Hi everyone. So let's start with the part 2 for income tax marathon. The last chapter which we were doing in the last part was PGPP. So let's start with the capital gains here. Capital gains, again, an easy chapter and important as well. So let's quickly revise this chapter as well. We have section number 45 till 55 which are covered in this particular chapter. You don't have to remember the section number, but yes, there are one or two section number which I'll be emphasizing that please learn those number with the numbers, right? Otherwise, you should know the provisions. That's okay. Now, section 45(1) is a charging section for capital gain. Two things are very important. If the capital asset is getting transferred, so there should be a capital asset first of all, and it should be getting transferred. So in the year of transfer itself, we are going to tax you. So in the year of transfer itself, again, I'm repeating, whenever the capital asset is getting transferred, we are going to levy the capital gain tax on the assessee. Correct? Although there are few exceptions to it that we will be doing it. Okay, let me cover those exceptions also. I'll be covering with the section number. No need to remember the section number, but you should know the provisions. We know that in 45(1)(a), that is in case of insurance claim. So section 45(1)(a), that is insurance claim. In this case, whenever the capital asset is transferred, when the capital asset is transferred, in that case, when the asset is destroyed. So in the year when the asset is destroyed, the transfer will happen, but we are not going to tax in that year. We will be waiting till the insurance claim is received from the insurance company. So this is insurance claim. This is one of the exception where the year of transfer and the year of taxability can be different. Correct. Second exception is, don't need to remember the section number again, 45(2). Whenever a capital asset is converted into a stock in trade. So whenever this conversion happens, it is the year of transfer. But the year of taxability will be in the year when the actual stock is getting sold. So here also the year of transfer and the year of taxability can be different. The third and the last one for our course is 45(5). Again, no need to remember the section number. 45(5) is case of compulsory acquisition. Whenever asset is compulsory acquired, let's say land is compulsory acquired, building is compulsory acquired. So the year of compulsory acquisition is the year of transfer. But we will not going to tax right here. We will be waiting. It will be delayed till the actual compensation is received. So here again, the year of transfer and the year of taxability can be different. So these are the three exceptions. Otherwise, in all other cases, the year of transfer and the year of taxability should be the same. Correct? Okay. Now, capital asset. What is a capital asset? We should know the definition of capital asset. Section number. Okay. No need to remember the section number, but you should know what are the capital assets. All assets are capital assets. Majorly, all assets are capital assets except stock in trade. So stock in trade is not a capital asset. Whenever you will be selling your stock, it is your PGBP income. It is not your capital asset. Second is personal movable assets. Let's say we have a personal car, personal furniture, which are movable. If they are immovable, land or building, if you are selling personal land or building, that is capital asset. But personal movable, your furniture, your car, clothes, etc., these are not capital assets. But we have certain exceptions to this also. I'll be doing it. Rural agriculture land is not a capital asset. Got it. Gold deposits bond and special bearer bonds are also not a capital assets. Got it. But there are certain personal movable assets. There are certain personal movable assets which would be regarded as a capital assets. Gold, jewelry, precious, semi-precious stones would be the capital assets. Paintings, drawings, sketches, sculptures, archaeological work of art. These are capital assets. Securities, whenever you will be selling your shares, debentures, etc., bonds, etc., it would be your capital assets. Got it? Or even virtually digitally assets like bitcoins, etc., that would be your capital assets. So these are capital assets. For securities, for FIIs, foreign institutional investors, not so important, but foreign institutional investors, whenever they will be selling their securities, it will also be capital gain for them. Correct? It would be not be their PGBP income, it would be capital assets for them. Okay. Now, how we will be determining whether the asset is a long term or a short term asset? It depends on their holding period. So if the holding period is up to 1 year, 2 year, or 3 year, as the case may be, it is short term. But if it is more than 1 year, 2 year, or 3 years, it would be long term. Got it? So 1 year is applicable for listed securities. So whether you are selling your listed shares, whether you are selling your listed debentures, listed bonds, it would be 1 year. Correct? So listed shares, listed bonds, etc., 1 year. Equity oriented units of a mutual fund, 1 year. Got it? Units of UTI, zero coupon bonds. So these four, if they are the holding period is up to 1 year, short term, more than 1 year, long term. 2 years would be for unlisted shares, only for unlisted shares, not for any other unlisted securities, unlisted debentures, unlisted bonds, etc. It would be 3 years. But unlisted shares, equity or preference shares, it would be 2 years. Land or building, please remember, don't make a mistake over here. For land and building, it is 2 years. Got it? And for all other assets, it is 3 years. Market linked debentures and specified mutual funds, mainly just remember market linked debentures, irrespective of the period of holding, it will always be short. Market linked debentures, there is a section 50 AA. It says that now market linked debentures or specified mutual funds, just remember market linked debentures, MLD, irrespective of the holding period, they will always be short term. Now, how we compute our capital gain. Section 48 says simply selling price minus cost price. Selling price is our full value of consideration. Cost price is our cost of acquisition. So what you need to do is cost of acquisition, cost of improvement, and expenses on transfer. Just subtract it from the full value of consideration. What is full value of consideration? Selling price generally, right? Why I'm saying generally, because sometimes we take some other value also in case of selling price that I'll be discussing. So full value of consideration, mainly selling price minus COA, COI, and expenses on transfer. This will give you short-term capital gain. But in case of long-term, you know that cost of acquisition and cost of improvement shall be indexed. How it will be indexed? Index cost of acquisition is equal to CII of the year of transfer. Please remember CII of the year of transfer. In case of, don't make a mistake, in case of, let's say, insurance claim, or in case of stock in trade, capital is set into stock in trade, in the case of compulsory acquisition of land and building, etc., you understand that the year of transfer and the year of taxability can be different. So in the numerator, please always, although it is taxable in the year of taxability, but please in the numerator only and only keep the CII of the year of transfer only, right? The CII of the year in which it is destroyed, whether it is compulsory acquired or it is converted, right? So CI of the year of transfer divided by CI of the year of acquisition. Now you also remember there is a special case, Manjula J. Shah. In case the assessee has obtained this capital asset from the previous owner. Let's say the daughter has obtained this asset from the father, then the CI of the year of acquisition would be taken from the father itself, right? From the previous owner. So both the options are correct, but I would highly appreciate if you will apply Manjula J. Shah, right? So CI of the year of transfer divided by CI of the year of acquisition into cost of acquisition. Got it? And CI would be given to you, but we know that this year CI is 348. Previous year 23-24 CI is 348, and the base year is 2001 and 2. The CI was 100, right? If any asset is acquired before 1/4/2001, you understand the actual cost or the fair market value as on 1/4/2001 can be taken. But in case of land and building, please don't make a mistake over here. In case of land and building, if it is any land or building is acquired before 1/4/2001, then the actual cost or the fair market value, whichever is higher. But if stem value is also given of 1/4/2001, then the fair market value should not be more than the stamp duty value. So in other words, I would say that please first of all compare if stamp value is also given of 1/4/2001. So fair market value of 1/4/2001, stamp duty value of 1/4/2001. So first of all, you have to take the lower of the following. Just take the lower of the following, right? Then compare with actual cost, whichever is higher should be your cost of acquisition. Correct? And any improvement done before 1/4/2001 shall not be taken, shall be ignored always, right? And please remember, for bonds and debentures, there would be no indexation. Even if they are long term, generally, we understand if they are listed bonds or debentures after 1 year, it will be long term. If they are unlisted after 3 years, they will be long term. But you don't have to do the indexation for bonds and debentures. Only there are two bonds where indexation is allowed. One is SGB, sovereign gold bonds, and other is capital index bonds. Not that important, right? 45(1)(a) insurance claim, I've already discussed that whenever the asset is destroyed and the assessee is receiving insurance claim from the insurance company, so the year of transfer and the year of taxability can be different. What is the full value of consideration? Whatever you receive from the insurance company, that is the full value of consideration, right? But here the year of transfer and the year of taxability can be different. 45.2, conversion of capital asset into stock in trade. If you have a capital asset, let's say, assessee has purchased a capital asset. The capital asset is purchased for rupees 10 lakh few years back, and after some time it is converted into stock in trade. So this is the conversion date. It is converted into a stock in trade. This is the conversion date. So here the transfer will happen. This is the year of transfer when the asset was converted into stock in trade. But we will not going to tax it. We will not going to tax it. So we will be taxing it in the year when it is actually sold. When it is actually sold. So here it is converted into stock. So what is getting sold? Stock is getting sold. So here it would be PGBP income, right? But let's say it is sold for rupees 22 lakh. So can we say that 22 minus 10, 12 lakh is my PGBP income? The answer is no. You understand, this area up to the conversion area, it was capital gain. And after that, it is stock in trade. This is PGBP. So what will be given to you in the question? You will be given with the fair market value on the date of conversion. So let's say the fair market value on the date of conversion is 15 lakh. Correct? So how much would be the PGBP? This blue area would be PGBP. 22 minus 15. 7 lakh would be your PGBP income, and capital gain would be 15 minus 10. 5 lakh would be the capital gain. Full value of consideration, what you will take? 15 lakh minus cost of acquisition, 10 lakh. And if this period, this red period, is a long-term period, then you have to index 10 lakh also. And how you will be indexing a CII of the year of transfer. So this transfer happens here, but the taxability would be here. Understood? So please don't make a mistake over here. This is quite important. Now, next section is 45.5. 45.5 is related to compulsory acquisition of a capital asset. So whenever a asset is compulsory acquired, so let's say land or building is getting compulsory acquired, in the year of acquisition, it would be the year of transfer, but we will wait till the actual compensation is received. So whenever the compensation is received, we are going to tax it. Correct? So capital gain will be taxable in the year when the compensation is first received, and the full value of consideration would be the compensation which is fixed by the government. So let's say even if you have receiving in parts, let's say government has fixed that they will give you 50 lakh rupees as compensation. But as of now, they have given you 15 lakh. Then after a few years, they are giving you some other amount. But 50 lakh is fixed. So whenever the first compensation is received, please make it taxable. How you will make it taxable? Full value of consideration 50 lakh. Please take entire 50 lakh. Although examiner might not give you that you are receiving in installments, but yes, the law is even if you are receiving in installments, please make it taxable entirely, whatever is your compensation. Correct? And if subsequently, if enhanced compensation is received, so whenever the enhanced compensation is received, again it would be taxable as a capital gain. What type of capital gain it would be? Long term, short term, it depends upon the original capital gain. If the original capital gain was long term, this would be also long term. And the cost of acquisition and cost of improvement would be zero in case of enhanced compensation. Why? Because you have already claimed the cost earlier. Correct? But yes, if there are any expenses on transfer, litigation expenses, legal expenses, that you can deduct. If the compensation is reduced, in case the compensation is reduced, then examiner will not ask you, but you should know if the compensation is reduced, then whatever the calculation we have made originally, that needs to be rectified. Correct? Interest on delayed compensation, whether the enhanced compensation is delayed or the original compensation is delayed, if you receive the interest, let's say you receive 2 lakh rupees as interest, so this would be your IFOS income. But in IFOS, whenever we are going to tax it, so there is a flat deduction of 50%. Please remember, there is a flat deduction of 50%. So out of 2 lakh, only 1 lakh would be taxable as IFOS. Whatever is the interest in the year when it is actually received. So interest is taxable on receipt basis. So if you are receiving interest related to some other period also in this year, so whenever it is taxable only on receipt basis. So whatever the interest which is received during the previous year, it will be taxable, but please give 50% of flat deduction over there. Got it? So this was 45.5. Then section 46. 46 is not so important, but still, whenever the company is getting liquidated, and they are giving assets or cash to their shareholders. So what are shareholders doing? Shareholders are actually surrendering their shares. So it would be capital gain in the hands of the shareholder as if they are selling the shares to the company. So this is called liquidation at the time of liquidation. So whatever the capital gain will be taxable in the hands of shareholder. So the capital asset here is the shares. So whatever you are getting from the company, let's say you are getting some cash from the company, or if you are getting any other asset from the company, you have to take the market value of the asset. So whatever the company is giving you, just take the market value of that asset plus your cash minus if there is any, let's say company is giving to a shareholder rupees 10 lakh. It includes cash as well as the market value of the asset which you are receiving. But the accumulated profit right now is 2 lakh. So just subtract 2 lakh from it, because 2 lakh would be the deemed dividend under section 222C. 2 lakh would be the deemed dividend up to the extent of accumulated profit, and over and above would be the value of for your consideration. So 10 lakh, whatever you are receiving, minus 2 lakh accumulated profit, 8 lakh would be the full value of consideration in the hands of shareholder minus cost of acquisition of the shares. Got it? So this is section 46. 46A, again, not at all important, buyback of shares. Whenever the company will buy back their shares, it would be the capital gain. It should be the capital gain in the hands of the shareholders. So here, please remember, when although there is an amendment in the recent budget, but that is not applicable for January 25 examination. That is applicable for May 25. So you don't have to do it. So 46A, buyback of shares or specified securities. See, in case of buyback of shares, whether these are listed shares or unlisted shares, buyback of shares only in case of shares, although the shareholder is selling their shares, and they are getting money from the company, so it should be taxable in the hands of shareholder. But you know that in 46A, they say that we are not going to tax the shareholder, we are going to tax the company. So in this case, capital gain will be rising in the hands of the company, and there is a flat rate of 20% plus surcharge 12% plus health and education says 4%. And I'm telling you, not at all important. Buyback of other specified securities other than shares, it will be taxable in the hands of the share security holder only. Right? It would be simply. Next, section 47, transactions not regarded as transfer. So we understand that there are certain transactions, although we can see that the capital asset is getting transferred from one person to another person, but still we are not going to tax it. So it says distribution of capital asset on the total or partial partition of HUF. Whenever the HUF is partitioned, then if they are giving any capital asset to their member, capital gain will not arise in the hands of HUF. In the member also, there would be no IFOS income as well. And whenever this member would be selling it, there would be the concept of the previous owner. So they have to take the holding period and the cost of the HUF. Got it? Whenever the capital asset is transferred and by way of gift, will, or inheritance. So if the father has given the gift to the son or daughter, then in that case there would be no capital gain in the hands of father. There would be no IFOS income in the hands of receiver also, because they are getting it from a relative. And there would be no capital gain. But whenever the son or daughter would be selling it, the previous owner concept will be taken place. Correct. But if we are giving this gift, if we are giving this gift to a non-relative, let's say that Mr. A is giving this gift to a non-relative. In that case also, in case of Mr. A, because he is giving by way of gift, there would be no capital gain. But in the hands of receiver, it would be IFOS income. Why? Because he is getting a gift, and that too from a non-relative. So it would be IFOS income. So it would be taxable. Whatever is the value of that gift. So in case of, we understand in IFOS, we will do that if in case of land and building, we take the stamp duty value. In case of others, we take the market value. So whatever is the market value, stamp duty value, as the case may be, in the hands of the receiver, it would be taxable. Correct? Provided the value is more than 50,000, that is an IFOS concept. But whenever this person would be selling it, whether the previous owner concept will be there? No. Why? Because whenever he received it, it was already become taxable. Now there is no concept of previous owner. Previous owner concept only arises only and only when there was no tax implication when the asset was transferred, right? So there was no tax implication either in the hands of transfer, either in the hands of receiver. So let's say if we give to a relative, then previous owner concept will arises. But if we give this gift to a non-relative, previous owner concept will not arise. Got it? Now, transfer of capital asset by a holding company to its 100% subsidiary company. provided the subsidiary company is an Indian company. The receiver company should be an Indian company or vice versa. Subsidiary company is giving a capital asset to the 100% holding company. If it is just holding company, then no capital gain will arise. It should be a 100% holding company. 99% no, it should be 100% holding company, right? Transfer of issue of shares by the resulting company in the scheme of demerger. Whenever the in case of demerger also, so whenever the capital assets are transferred by the old company to the new resulting company, then there would be no capital gain. Second thing, in the case of amalgamation also, in the case of demerger also, whenever the shares are given to the original shareholders, to the existing shareholders, there would be no capital gain. And whenever these, let's say, Myntra Limited is getting amalgamated with Flipkart Limited, so Myntra Limited is getting amalgamated into Flipkart Limited, and let's say I was the shareholder of Myntra, but during the time of amalgamation, I was given the shares of Flipkart. So my shares of Myntra got exchanged with Flipkart. In this case, capital gain will not arise. Capital gain will not arise. But whenever I'll be selling this new company shares, the cost of acquisition would be of the previous shares. Got it? And the holding period would also be for the previous shares. These were regarding the shares of amalgamated company in the case of amalgamation or demerger. Whenever the debentures are converted into shares, convertible debentures, there would be no capital gain, right? And whenever these shares are sold, we will be taking the cost of acquisition of the original debentures. Got it? Transfer of rupee denominated bonds outside India by a non-resident to another non-resident, that we have already done in regular classes or practice batches. So you all know that not so important. Whenever, why? Because whenever the government issues these types of bonds, whenever uh, government issues these types of bonds, they actually want that whenever a non-resident is selling to another non-resident outside India, there should be no capital gain. Otherwise, that non-resident will not going to invest here in India. Redemption of sovereign gold bonds by RBI only for individual assessee. See, sovereign gold bonds are capital asset, and whenever they would be sold, there would be capital gain, and indexation is also available over here. Although for bonds and debentures, indexation is not available, but we have few exceptions, and one of the exception is sovereign gold bonds. So whenever these sovereign gold bonds are sold, capital gain will arise. But if RBI says, because RBI would like to actually enhance they would like to spread the awareness that people should actually take it. We should give an incentive to the investors. So we are giving incentive to the individual investor. Please take 7 gold bonds, and whenever you will be redeeming it, there would be no capital gain. Only in the case of individual. Got it? Then transfer of paintings, drawings, sculptures. We understand whenever we will be selling the paintings, drawings, sculptures, etc., capital gain will arise. But if we are selling these paintings, drawings, etc., to government, to National Museum, National Archives, etc., or approved universities, then there would be no capital gain. Conversion of physical gold into EGR or vice versa. You understand whenever the physical gold is converted into electronic gold receipts, then there would be no capital gain, or electronic gold receipts are converted into physical gold, there would be no capital gain. But whenever you will be selling directly the physical gold, capital gain will arise. Whenever you will be selling the EGR, capital gain will arise. But on the conversion of physical gold into EGR or vice versa, capital gain will not arise. And also the transfer in case of reverse mortgage for senior citizen, whenever they transfer their asset in the favor of bank, etc. In case of reverse mortgage, also capital gain will not arise. Right? Okay. Section 50. Section 50 is simple. Capital gain in case of depreciable assets. So whenever depreciable assets are sold, where you are charging depreciation on WDV method, that is on block of assets. So you understand, let's say in the opening WDV of plant and machine, there is a block of plant and machinery. Let's say there is a block of plant and machinery. Plant and machinery 15% is the block, and it has some 2 or 3 machines. Opening WDV of the block is, let's say, 20 lakh. Additions during the year, let's say we have purchased one more machine of rupees 5 lakh, less money received on sale, money received on sale or disposal. And let's say you have sold partial block only. Let's say partly the block is sold, not the full block is sold. Partial block is sold, but it is sold at such a high price that it is exceeding these two. It is exceeding these two. So let's say total of these two is 20 plus 5, 25. And you are selling it for, let's say, 26 lakh. only part of the block is getting sold, but it is getting sold for more than this value, then in that case, what we will say, negative 1 lakh? No. What we will say, that WDV at the end for charging depreciation would be nil, because now we will not be able to charge depreciation because we have already recovered the entire money. And the 1 lakh rupees, which is extra money which we have recovered, would be the short term capital gain. Section 50, depreciable asset will always be short term. You understand? Are you able to recall this provision? Section 50 will always be short term. Let's say if we have the opening value was 20 lakh, additions during the year 5 lakh, and we have sold the entire block. Let's say entire block is getting sold for 32 lakh. In that case also, the capital gain will arise. How much it would be? 20 plus 5, 25. And you have already recovered the amount that is in excess of that. How much? 7 lakh. So WDV at the end would be nil because the entire block is sold, and 7 lakh would be the capital gain. In case there would be loss also, so let's say the opening value was 20 lakh of the block. Let's say we have 2 or 3 machines, and 5 lakh is the additions during the year, and we have sold the entire block but at a lesser value. Let's say we have sold it for 10 lakh rupees. Then in that case, can you charge depreciation? No. Why? The entire block is sold. Here the entire block is sold, so we cannot charge depreciation. In that case, there would be a short term capital loss. How much? 20 plus 5, 25 minus 10, it would be 15 lakh would be the short term capital loss. Got it? So this was section 50. So section 50 says that how you will be computing the capital gain or capital loss in case of depreciable assets. Section 50A, whenever you transfer your individual asset, we have already done in PGBP portion also. So let's say there is a power generating asset where depreciation is charged on individual basis, or there is a scientific research asset where we have 100% claim the deduction also. So let's say there is a scientific research asset. We have purchased it some 1, 2, 3 years before, and let's say the original cost of this asset is 20 lakh. It was an individual asset. And how much is the WDV? Because it's a scientific research asset, we have claimed 100% deduction under section 35. The WDV is nil, correct? And original cost was 20 lakh. Now if we are selling it, the value which is up to 20 lakh. So up to 20 lakh, we understand it would be PGBP income, D in PGBP under section 41, right? But if we are selling it at any value more than the original cost, then capital gain will be arising. So let's say we are selling it for 24 lakh. So 24 lakh minus 20 lakh, full value of consideration 24, cost of acquisition 20, 24 minus 20, 4 lakh would be your capital gain, correct? And if this holding period is more than 1 year, 2 year, 3 year, as the case maybe, depends on the nature of the asset, then 24 minus 20, you have to do the indexation for this 20 also. So this is a capital gain taxable under section 50A. So that this is not a actually block of asset, it is an individual asset. So whenever individual assets on which you charge either depreciation individually, that is on SLM basis, or you charge specific deduction like section 35, 100% deduction you have claimed. So in that case, whenever the individual assets are sold, so please compute the capital gain accordingly. In case of slump sale, whenever a various capital assets are sold for a lump sum consideration. So let's say the assessee has sold his entire undertaking. All the assets, all the liabilities he has sold for a lump sum consideration. That is called slump sale. So section 50B says, what is the full value of consideration? Whatever is the selling price or the fair market value of that undertaking, whichever is higher. First of all, please remember, full value of consideration would be the selling price, or if fair market value is not given, then you can ignore it. You can take the selling price, but if fair market value is given, just check whichever is higher. That should be the full value of consideration. Minus cost of acquisition should be, we will not take cost of acquisition or cost of improvement in this case, but we will be taking net worth of the undertaking. So how net worth is computed? Total assets of that undertaking only, right? Of that unit only. If we have unit 1, unit 2, and unit 2 is getting sold, you have to take all the assets value of the unit 2. So take all the assets value of the unit 2, add all these assets minus outside liabilities. Outside liability like bank loan, creditors, etc. But only of unit 2, which is getting sold, right? So total assets of unit 2 means unit 2 is getting sold. So total assets of unit 2 minus outside liabilities of unit 2. But please remember, when you will be taking the assets of unit 2. If there is any revaluation which has taken place, so you have to take the value before revaluation. So nullify the effect of revaluation, you have to take the value before revaluation. Got it? First thing. Second, if there is any asset on which proper depreciation is not charged, if it is given to you in your question that the assessee has not charged depreciation for last 2 3 years, then you have to charge the depreciation also. So if there is any depreciable asset, please make sure that the proper depreciation should be charged on it. So you have to take the value when you will be calculating your assets value. Please take the value only after charging proper depreciation. Third, if there is any 35 AD asset or 35 asset where you have claimed 100% deduction, the value of that asset should be taken as nil. Not so, this point is not so important, but please remember, if you have already taken 100% deduction on any asset, please take the value as nil over here. So total assets minus outside liability will become your net worth. It will be your cost of action. Instead of COI, you will be taking the net worth. And please tell me whether we have to index it. No, net worth will not be indexed. Minus expenses on transfer. If there is any expenses on transfer, please take that. This would be your capital gain. It would be long term or short term, depends upon if the this unit is more than 3 years old, then long term. Otherwise, it would be short term, right? But indexation would not be there of net worth. So 50B is quite important. Next, 50C, very very important section. 50C, real estate transaction. Whenever the assessee is selling their or transferring their land or building or both, so whenever land or building is transferred, so we have to see the full value of consideration should be the actual selling price. Selling price should be the full value of consideration. But if the stamp duty value on the date of sale, on the date of transfer, if the stamp duty value is more than 110% of the selling price, please remember this, 10% grace we can give, but stamp duty value is more than 110% of the selling price, then in that case, stamp duty value would be the full value of consideration. Please don't take the selling price then you have to take the stamp duty value as the full value of consideration. Now, stamp duty value should be taken at the time of transfer, at the time of registration. But if there is a prior date agreement, and the assessee proves that, sir, there is a prior date agreement and actually some consideration is already received at the time of agreement in the form of, not in the form of cash. It should be any other mode other than it should be not a cash mode. It should be a banking mode. So if you have received any amount through banking mode, account pay check, account pay bank draft, ECS, NEFT, etc., then we can take the stamp duty value of the agreement date also. So please remember, if there is any amount which you have received, with either the full consideration or part of the consideration, even 1 lakh rupees, 2 lakh rupees, if you have received through banking mode, then we can take the stamp duty value of the agreement date. Got it? So 50C is very important. And yes, in case if the assessee is disputing the stamp duty value, then he can ask the assessing officer that, sir, please appoint the valuation officer. If the valuation officer is appointed and valuation officer brings a value, why valuation officer is appointed? So that he can bring a value which should be less than the stamp duty value. But this valuation officer comes with a value which is more than the stamp duty value, then we will not take the value of the valuation officer, right? We will not take the value of the valuation officer if he brings more value. But if he brings the lesser value than the stamp duty value, if he brings a lesser value than stamp duty value, then we can take the value of the valuation officer. But please remember, the value should not be less than the actual selling price. Please never take the value which is less than the actual selling price. One more important point where you can make a mistake: expenses on transfer. Expenses on transfer, let's say it is 1%. So 1% of what? Always on the selling price, actual selling price. Although full value of consideration, you might be taking stamp duty value, but expenses on transfer should be, if it is in the form of percentage, then it should be of the selling price, right? 50CA. 50CA is a very, very small section, but it's an important section. If unlisted shares, whenever unlisted shares are sold, so if the selling price, if the fair market value of the share is more than the selling price, then we will be taking the full value of consideration as fair market value. If the market value of the unlisted shares, I'm again repeating, if the market value of the unlisted shares is more than the selling price, then we will be taking the full value of consideration as the market value. If the selling price is more, then selling price can be taken. If fair market value is more, then the market value would be taken. So 50 CA is very important. 50D, it will not come in examination, but it says that if full value of consideration is not ascertainable, we will be taking the market value. So 50D, simple section, it will not come. 51, advance money forfeited. So today, whenever this advance money is forfeited, it will become IFOS income in the year of forfeiture itself. But it was not the case before 1/4/2014. So if any advance money is forfeited on or before 1/4/2014, now there is no problem. So you have to see the date of the forfeiture. If the amount is forfeited on or after 1/4/2014, simply it will become the IFOS income in the year of forfeiture. But if the any amount is forfeited before 1st April 2014, if the amount is forfeited before 1st April 2014, it will not be the income in the year of forfeiture, but we have to wait till the asset is actually sold. So whenever the assessee is selling this asset, it will be reduced from the cost of acquisition. Got it? Now let me first cover exemptions. Let me first cover the exemptions. See, these exemptions are quite important. 54, 54B, 54EC, and 54F. All four exemptions are important. 54D is okay type. So let us see exemption under section 54. 54 is available only to individual or HUF. Only to individual or HUF if they sell their resident. If the residential uh, property, residential house is getting transferred, and if they purchase the residential house only. So individual or HUF, if they are transferring the residential house and they are purchasing a residential house, the residential house which is getting transferred should be a long-term residential house. How much would be the amount of exemption? The amount of exemption would be the gross capital gain, amount invested in new residential house, or rupees 10 crore. 10 crore is a fixed limit now. So it should not be exceeding, the exemption should not exceed more than 10 crore. So amount invested, gross capital gain, or 10 crore, whichever is lower. And sometimes, because we understand we have been provided a good time period to purchase or construct this asset. So let's say the residential house can be purchased in before 1 year or after 2 years also. It could be constructed in next 3 years also. So in case if up to the due date of ROI we are not able to purchase or construct new asset, then in that case we can invest this money in the capital gain scheme as well. So whenever you will be investing in the capital gain scheme, it is also recognized that yes, it is a proper investment. So let's say if in your question the assessee has also purchased the asset and also invested in capital gain scheme, please do the aggregate of the both, right? Because it might happen that he has purchased a house, let's say of 1 story, 1 floor, and he would like to build one more floor. So that is the reason he has invested in capital gain scheme. So whatever the amount is invested in the capital gain scheme or in the new house up to the due date of ROI, please that aggregate both of the things, right? And you should, whenever the exemption is claimed by investing in capital gain scheme, because capital gain scheme is just a temporary preference which has been given to you, but it's a just a temporary option which has been given to you, but you have to actually purchase or construct the residential house. If you will not purchase or construct the residential house till the expiry of that period, then whatever the amount you have invested, it would become your, the exemption will be withdrawn and it will be your capital gain. Correct? 54B. 54B is on agriculture land. So whenever the agriculture land is transferred, obviously it's an urban agriculture land, because rural agriculture land is transferred, there would be no capital gain. So if the urban agriculture land is transferred, assessee is an individual or HUF who were using this agriculture land for at least last 2 years for agriculture purpose. Then if they are selling their agriculture land and new agriculture land is purchased within 2 years, right? The new agriculture land can be urban agriculture land, it can be rural agriculture land also. So in that case, capital gain can be exempted under section 54B. It can be exempted under section 54B, right? Just give me a moment. It will be exempted under section 54B. How much? The amount invested, gross capital gain, whichever is lower. Amount invested or gross capital gain, whichever is lower. Whether the capital gain scheme is applicable over here, yes, it is applicable. Sorry. So whatever you invested, if you have not invested in the rural agriculture land or urban agriculture land, and the capital gain scheme, if you have invested, you will be getting the exemption also. 54 EC. 54 EC is important. It is applicable for any SSE. Individual HUF also can take. Any other SSE can also take. If they have transferred their long term, if they have transferred their long term land or building, if they have transferred their long term land and building, so they can take exemption under 54 EC. Plus, if they are investing in bonds, NHAI, RECL, or other notified bonds, mainly NHAI, National Highway Authority of India, RECL, Rural Electric Corporation Limited, if they are investing in bonds within 6 months. So from the date of transfer, it should be invested within 6 months. Maximum exemption would be amount invested or capital gain or rupees 50 lakh. So please don't take exemption more than 50 lakh rupees. So please remember this 50 lakh rupees limit in 54 EC. 54F. 54F is available to individual or HUF who does not own more than one residential house. This exemption is available if you have transferred any long-term asset, if you have transferred your shares, if you have transferred your jewelry, if the assessee has transferred their land other than residential house. So if the assessee has transferred any long-term asset other than residential house and they are purchasing residential house, then the exemption is available under section 54F. Got it? Exemption is available under section 54F. How much is the exemption available? Amount invested upon net consideration into capital gain. So this is important. This is important. So 54F says that the exemption will be provided on the formula base. So whatever is the amount invested divided by net consideration. What is net consideration? Full value of consideration minus expenses on transfer. So amount invested upon net consideration into capital gain would be your exemption. Either you can purchase a residential house, construct a residential house, or even if you invest in capital gain scheme, you will be getting this exemption. So 54F is again an important. 54D, not so important. It is only and only for the people who are engaged in their manufacturing operations, who have factory. If their factory land or building is getting compulsory acquired, so the scope is very, very limited of 54D, but yes, it's a very easy section. So whenever the person is a manufacturing concern and their land and building, factory land and building is getting compulsory acquired and there is a capital gain, then they can claim an exemption under 54D if they would be investing in their new factory land or building, right? In new factory land and building, or it could be within 3 years they can invest. Therefore, the capital gain scheme is also applicable. So here in 54D, the amount of exemption would be the amount invested or capital gain, whichever is lower, right? So these are the important exemptions. The most important exemptions are these. All four are important. If you still will ask me, 54, 54 EC, 54F are more important. 54B is also easy, similar exemption. But yes, these four exemptions are quite important for you. So before I go to IFOS, let me discuss the capital gain in case of shares or securities also. See, first bonus shares and then right shares. Bonus shares, you all know bonus shares are allotted free of cost to us. So the cost of acquisition would be zero. But in case the bonus shares are allotted before 1st April 2001, I'm repeating, if the bonus shares are allotted to you before 1/4/2001, then the fair market value as on 1/4/2001 can be taken as the cost. Otherwise, it should be zero. Correct? Second, right shares. See, if the original shareholder has some existing shares and a right shares are offered to him by the company. So we all know what are right shares. It would be given to you at less than the market price. So let's say the market price of the share on that date is 500, but we are giving you an offer that you can purchase it for 300 rupees. So if you are exercising this right, then you will get this share and you have to pay 300 rupees. So 300 rupees would be the cost of acquisition. Whenever these right shares are allotted from this date, your cost of your holding period will start. That's it. Simple. So if you exercise the right, whatever is the amount which you have paid to the company, that is this subsidized price, that concessional value would be the cost. Let's say the original shareholder says, okay, I'm not taking this shares. Let me renounce this share in some other favor. He's transferring his right to some other person. Some other person, let's say he has been given a right that he can purchase this number of shares, but he is not purchasing it. He's transferring his right. So whenever this right is transferred, capital gain will also arise. So whatever the money which he is receiving for transferring this right, so what is the capital asset over here? The transfer of that right, that offer letter which he is transferring, that is the capital asset. So whatever the money which he is receiving from that other person would be the full value of consideration. And the cost of this asset is not transferring shares, he's transferring that right. So the cost of acquisition would be nil in that case because he has not spent any amount on getting this letter, right? This letter came because he was the existing shareholder. That's it. So the cost of action would be zero and it would be a short-term capital gain. Why short-term capital gain? Because it has been done in 30 days only. Because you get only 30 days to exercise the right, and if you're not exercising it, you are renouncing it within those 30 days. It would be a short-term capital gain. Got it? The last point in right shares. The person in whose favor we have renounced this right. The other person. I'm calling it this person as an other person. So other person will now has a right. He can purchase the shares. So what is the cost for him of these shares? Whatever he is paying to the company, that is also a cost. And whatever he has paid to the original shareholder, that is also the cost. So just aggregate the value which he has paid to both of these people. To the company, let's say he's purchasing for 300 rupees per share. So 300 he has paid to the company. And to that person, he has paid 20 rupees per share he has paid to that person. So his cost of acquisition of this share would be 320 rupees. So this was about right shares. I believe that you are able to recall this. Next, 112A and 111A. See, whenever 111A or 112A, whenever equity shares, equity oriented units, mainly in for your examination, equity shares is most important. Whenever equity shares, equity oriented units are transferred. There is one more, but that is not in your course. Units of business trust, right? That is not in your course. Mainly for your examination purpose, equity share is most important. So whenever you transfer your equity shares on a stock exchange, where RSC on a recognized stock exchange, where STT is charged, then we call it either if it is short term, then 111A, and it is at has a special rate of 15%. So full value of consideration, the selling price which you are selling it, cost of acquisition, whatever you have purchased it, there would be no cost of improvement in case of shares. Expenses on transfer, whether STT is allowed? No, STT is never allowed while computing capital gain. If you have paid the brokerage, etc., that is allowed. Brokerage, if you have paid at the time of transfer, that is an expense on transfer, but STT is never allowed. STT is allowed only as a business expense under PCBP, but not as a in capital gain. So please don't allow STT, and this would be your capital gain taxable at a rate of 15%. This is 111. Correct? 112A. If these shares are long term, more than 1 year, up to 1 year short term, and more than 1 year, it is long term. So if these shares are sold and these are long term, they are sold on stock exchange, recognized stock exchange, where STT is charged, then it would be 112. Full value of consideration, whatever is the selling price. Cost of acquisition, whether you have to index it, no, please don't index it, right? You don't have to index it because we are already giving you a benefit of 10% reduced rate of tax. So we'll not be giving you the benefit of indexation. So cost of acquisition would be there, whatever is your actual cost, minus improvement cost is not there on shares. Expenses on transfer, again, brokerage expenses, etc. you can take, but not STT. So these would be your capital gain, which is taxable. Let's say this capital gain comes to 3 lakh rupees. So it is taxable at a rate of 10%, but in excess of 1 lakh. So just subtract 1 lakh out of it if you need to compute the tax also in your question. Then on 2 lakh, it would be 10%, 20,000 rupees. Got it? Now, a very important point. What is cost of acquisition in this case? See, if it is long term, what is the cost of acquisition? See, if this shares were acquired on or after 1st February 2018, this is important because in 2018, actually, this section was introduced 112A by Mr. Arun Jaitley. So if the shares were acquired on or after 1st February 2018, then you can take the actual cost. Then there is normal. Then there is everything is normal. You can take the actual cost. But in case these shares were acquired before this date, these shares were acquired on 31st January 2018 or before that, then what would be the cost of acquisition? In that case, it is important. You have to take the actual cost or the fair market value, the market value, the market value of the share as on 31st January 2018, just before this budget date, 31st January 18, whichever is higher. You have to take this value. Got it? So if they are acquired on or after this date, then no issues. Actual cost would be taken. But if they are acquired before this date, then you have to take the actual cost or fair market value as on 31st January 18. Market value. And which market value you have to take? If you have been given opening value of the opening price of this date, closing price of this date, then which value you have to take? You have to take the highest price. So on this date, whatever is the highest price, whatever is the highest price of the share, you have to take that as a cost. Got it? But please remember, this fair market value should not be more than this fair market value should not be more than your actual selling price. So it will be limited to your actual selling price. So when you will be taking this fair market value, please remember it should not be more than your actual selling price. So this is important 112A also. So this is 112A. See, here it is mentioned that if these shares or equity oriented units are acquired on or after 1st February 2018, then there is no issue. Then you can take the actual cost. But if they are acquired before that, then the actual cost of fair market value, whichever is higher, right? And but when you will be taking your fair market value, it should not be more than the actual selling price. If the actual selling price is more, then this fair market is fair market value. If the fair market value is more than the actual selling price, please limit it up to the actual selling price only. Got it? So this was 112A. Now let us start with IFOS, income from other sources. Under IFOS, the sections are from 56 to 59. And the most important is the taxability of gifts. So let us first concentrate on the taxability of gifts. See, whenever the gifts are received, if it is from your employer, it is salary income. Cash gift from the employer, fully taxable, whether it is less than 5,000, more than 5,000. Cash gifts are like bonus. It is fully taxable. In case of other gifts in kind from employer, they are taxable if the value is more than 5,000 rupees. Then you can make it fully taxable, or in excess of 5,000 also you can make it taxable. But I would suggest make it fully taxable if it is aggregate value is more than 5,000 rupees in case of employer. So from employer, it is salary income. Got it? If you receive from your clients, customers, or during the course of your business or profession, then it is PGBP income. You understand? It is PGBP. But if you receive from others, it is your IFOS income. So gifts received from others, other than employer, other than customers, clients, etc., then it would be your IFOS income. But we understand that there could be some exceptions also. Gifts received from relatives, etc., they are exempt. That we will be seeing it. But generally, gifts received from others, it is our IFOS income. So we are dividing these gifts into three parts. One is cash gifts, movable gifts, and immovable gifts. So whatever the cash gift, first of all, whatever the gifts which you are receiving, just make three parts of it. Cash gift, please make them separate. Movable gifts, count them separate. Immovable gifts, count them separately. So first, all the cash gifts which you have received. Whenever I am saying cash gift, it could be in the form of your bank. It could be in the form of check. It could be in the form of FD also. So if in your question you will get that the assessee has received an FD as a gift, it is also a cash gift, right? I mean monetary gifts. So all the monetary gifts which you receive, and if the aggregate value of this gift is exceeding 50,000, please don't aggregate cash and movable together. No, cash gift should be kept separate, movable gift should be kept separately. Got it? So whenever you will be receiving the cash gift, if it is more than 50,000 rupees aggregate, then please make it taxable. But we understand that gifts received from the following will be exempt. Let us first understand this. Gift received from the followings will be exempt. So if you are receiving gifts from relatives gifts can be received for any amount, more than 5,000, less than 50,000, doesn't matter at all. So even 5 lakh, 5 crore rupees you will receive from relatives in the form of any of them, it is not taxable. Gifts from relatives is not taxable. On the occasion of the marriage of the assessee, it is on the occasion of the marriage. So it is one of the favorite question of the examiner. They give that it is assessee's son's marriage or assessee's daughter marriage, they are receiving it. No. If the assessee, it is assessee's marriage, the bride is receiving the gift, the bridegroom is receiving the gift, then it is exempt. If their father or mother is receiving the gift from someone else, then it will be taxable. Got it? So on the occasion of the marriage of the individual, not on the occasion of any other occasion. So if it is anniversary, it is birthday, every time it is taxable. Only in the case of marriage it is exempt. Under a will or by way of inheritance, when we receive the gift, it is exempt. From any local authority or from any fund or foundation, which is an NGO, which is referred under section 1023C. You don't have to remember this section number, or section 12 AA or AB. So these are charitable institutions, so approved charitable institutions. So whenever we receive gift from any approved charitable institution, so examiner can give you that the assessee has received from Tata Memorial Cancer Research Institution, that is an exempt gift. From local authority, that is an exempt gift. From trust, institution, NGOs, etc., which are registered in the section 12 AA or 12 AB, these are also exempt gifts. So please remember, these gifts are exempt. COVID-19 related exemption is also there. If the person is suffering from COVID-19 positive, quote, for self or any relatives, who are the relative over here, spouse of the assessee, children of the assessee, or parents or brother and sister, if they are, sibling means brother and sister, if they are dependent, right? So if the assessee has received a gift, not as a gift, but a money in for the medical treatment of COVID-19 disease, then for medical treatment, it is fully exempt. Plus, he has to furnish some documents. He has to furnish the COVID-19 positive reports and other medical reports. So medical treatment, it is exempt. But on the death of the family member, if the person has received the gift, on the death, if it is received from employer, fully exempt. From others, it is exempt up to 10 lakh rupees. In excess of 10 lakh, make it taxable. So in case of death, although now COVID-19 is not that important from examination point of view, I don't think that in January 2024 or 5 examinations they will be asking you, but still, just keep it back of your mind that COVID-19 medical treatment fully exempt. On death from employer, it is fully exempt, but from others, if the person has received the gift in excess of 10 lakh, it will be taxable. So if any person has received on death from other person 11 lakh rupees, so minus 10 lakh rupees would be exempt, 1 lakh would be taxable. Got it? Now, cash gifts are exempt from non-relative. If you are receiving from relatives, it would be exempt always. These are taxable gifts, right? Cash gifts would be taxable if the aggregate is more than 50,000 rupees. If it is up to 50,000, then you can ignore. But if it is more than 50,000, please make it fully taxable. How much? If somebody has received 52,000 rupees, how much it would be taxable? Fully taxable. 52 entirely. Sir, in excess of 50, no. Entirely 52,000 would be taxable. Understood? Second, if the assessee has received movable gifts, but please remember these movable gifts for the receiver, they should be in the nature of capital assets. See, if we receive the gifts, which is a car, furniture, mobile phone, please don't make them taxable. Please don't make them taxable. If it is in the nature of capital asset for the receiver, like if the person has received gold, if the person has received shares, if the person has received any other capital assets, any paintings, drawings, sculptures, then it will be taxable, right? If the person is receiving car, if the person has received any other mobile phone, computer, laptop, etc., please don't make it taxable. It should be a capital assets in the hands of the receiver. So these movable gifts are generally capital assets in nature. So if these movable gifts are received by the assessee without any consideration, these are purely gifts which he has received, and the aggregate value of this gold, platinum, silver, precious, semi-precious stones, paintings, drawing, archaeological collections, etc. If the aggregate value, here you have to take the aggregate value. Can we aggregate? I'm again repeating. Can we aggregate cash and movable gifts? No. Please, cash gifts should be, monetary gifts should be kept separate. Non-monetary gifts, movable gifts should be kept separate. Immovable gifts should be kept separately. Now, without consideration, all the gifts which you have received, let's say gold you have received, shares you have received, paintings you have received, without consideration, you have not paid anything, but you have received the gift. Aggregate value, if it is exceed 50,000 rupees, the market value exceed 50,000 rupees, the aggregate value, then it would be fully taxable. Otherwise, you can leave it, right? But if you have received it with inadequate consideration, actually you have purchased this. So this is again a good question by the examiner, and they generally give it to you. Let's say they will say like this: Mr. A has sold unlisted shares to Mr. B for rupees, let's say 2 lakh, and the market value of this share was, let's say, 2.8 lakh. Correct? Now you have to calculate the income of both Mr. A and B. Now please tell me, here Mr. A is selling unlisted shares. So for Mr. A, it is a capital gain because he is selling shares, unlisted shares. How much he is selling for? 2 lakh rupees. Market value was 2.8 lakh. We understand that we have done section 50 CA. Whenever unlisted shares are sold, the full value of consideration should be, we will compare the actual selling price with the market value. So if the market value is more, we will be taking the full value of consideration 2.8 lakh minus cost of acquisition or index cost of acquisition, whatever is the cost. Right now, in this example, I'm not giving you the cost. So whatever is the cost, please reduce it. If it is long term for unlisted shares, more than 2 years, right? It is long term. So you have to do indexation also. For listed shares for 1128, etc., we don't do indexation, but for unlisted shares, etc., we can do indexation, right? So cost of acquisition, any expenses on transfer, this would be the capital gain. But the most important thing is that whenever you will be taking for Mr. A, this is for Mr. A, whenever you will be selling it, so if these are unlisted shares, please check the market value also. And if market value is more, then the full value of consideration will become the market value as per section 50 CA. Now, we are doing IFOS in the hands of Mr. B. He is purchasing this. What is, these are shares. Shares are capital assets for Mr. B. So these are movable things. Now he is getting it, movable assets. Now, how much consideration he is paying? 2 lakh rupees. And what is the fair market value? The fair market value is 2.8 lakh, and the consideration which they are paying is 2 lakh rupees, right? So this is inadequate consideration. And what is the difference? 80,000 is the difference. 80,000 is the difference. If this difference is more than 50,000, if it is up to 50,000, then we can leave it. But if it is more than 50,000, then it will become fully taxable in the hands of Mr. B. So this is called inadequate consideration. He has purchased these assets for inadequate consideration. So whenever you purchase these capital assets for inadequate consideration, it will be IFOS income in the hands of receiver also. If the difference is up to 50,000 or less, then you can ignore. But if the difference is more than 50,000, then please make it fully taxable. In this case, entirely 80,000 will be taxable. Got it? Right? So this is what with inadequate consideration means. You have purchased it for the lesser value. Just aggregate the fair market value of all such gifts minus the consideration paid. And if this difference is more than 50,000, please make it taxable. Third is immovable gift, that is land or building. So whenever we will receive this land or building, let's say without consideration, we are receiving it as a gift. See, if we are receiving it from our relative, then it would be exempt. But if we are receiving it from a non-relative, it would be taxable, right? Here you don't have to do the aggregate of immovable property. You have to look at each and every property as a separate property. So for, let's say the assessee has received 3 houses, then house 1 should be kept separate, house 2 separate, house 3 separate. Individual property should be seen. And if the stamp duty value, here we will be seeing the market value, but for immovable property, we see the stamp duty value. And if the stamp duty value is more than 50,000 rupees, then it would be taxable. Individual property. So let's say house 1, house 2, house 3, he has received as a gift. House 1 stamp duty value was 50,000, house 2 was 45,000, and house 3 was 60,000, let's say. So in that case, house 1, house 2 would not be taxable. We have to see individually over here. But in this case, house 3 would be taxable 60,000 rupees. But for movable gifts and for cash, we have to do the aggregate. We would have taken the aggregate if this would have been movable or cash gift. But for immovable, we don't do aggregate. Got it? Now, if you have purchased land and building for inadequate consideration, so whatever is the stamp duty value, if you have paid less, then what is the difference? Whatever the amount which you have paid less, If this difference is more than 50,000 rupees, it will be taxable, right? If it is more than 50,000 rupees, it will be fully taxable. If it is 50,000 or less, then you can ignore it, right? But yes, if the stamp duty value, you have to also look at the stamp duty value is up to 110% of the purchase price, then it's okay. But if it is more than 110% of the purchase price, then you have to make it taxable. Got it? And the stamp duty value of the date of registration you have to take. But in case in similar thing which we have done in capital gain, in case there is a prior date agreement and some consideration is paid through account pay check, account pay bank draft through banking mode, then you can take the stamp duty value of the agreement date also. I believe that you are able to recall this provision. So these are important. Taxability of gifts. Who are relatives? So relatives, you all know that there is a definition of, the scope is quite extended definition of relative. Spouse of the individual, brother of the individual or sister of the assessee, or brother or sister of the spouse of the individual. Spouse, brother and sister, if they have given us a gift, then also it is exempt. They are in the definition of relative. Uncle has given the gift, aunt has given the gift, parents brother, parents sister, father's brother, father's sister, mother's brother or mother's sister have given the gift, then it is also not taxable, it is exempt. Any linear ascendant or descendant, linear ascendant would be parents, grandparents, descendant would be children, grandchildren, it would also be exempt. Spouse, linear ascendant, spouse, father, that is if you have received the gift from father-in-law, mother-in-law, then also it would be exempt, right? Or any of the spouse, the people who are mentioned over here, if we have received from brother or brother's spouse, sister or sister husband, then also it would be exempt. They are all relatives. Section 57, little bit important. Deductions allowed from IFOS. So what are the deductions which are allowed from IFOS? In case of dividend income, there is no deduction allowed from IFOS. Whenever you receive the dividend, no deduction is allowed except only one. Only one deduction is allowed if you have purchased these shares by taking a loan. Then the interest which you are paying, that is the only the interest which is allowed. But that interest should be limited to 20% of your dividend income. It should not be more than 20% of your dividend income. Got it? And no other deduction is allowed. In case of family pension, please remember 1/3 of family pension. See, if the employee is receiving the pension, then it is his salary income. And if it is salary income, if the employee is receiving, there would be standard deduction also under that salary. But if the family member is receiving the pension, let's say the employee has died, now the family member is receiving the pension, then it is taxable under IFOS, but 1/3 of such pension or 15,000 rupees, whichever is lower, under both the regimes. Under both the regimes, 1/3 of such pension or 15,000 rupees, whichever is lower, would be exempt. There would be a deduction. Now, interest on delayed compensation, we have already discussed, 50% flat deduction would be there. Interest on post office saving account. Post office saving account. I'm not saying post office term deposit. I'm saying post office saving account. So if the person is getting a post office saving account income interest, then this interest, there is a flat deduction of 3,500. In case of joint account, the flat deduction is 7,000 rupees. So let's say if this person is receiving 13,500, give a flat reduction of 3,500 and IFOS income would be 10,000 only. And please understand, because this is a saving bank account interest, if the person is following optional regime also, then 80 TTA or TTB, as the case may be. If this person is a resident senior citizen, then TTB, otherwise TTA would also be available in case, because this is a saving account. So 10,000 would be IFOS income. And let's say this person is getting 80 TTA also in case he is following optional regime. Then see, 3,500 would be deducted anyways, whether any regime is following. But TTA, TTB is only under optional regime. Got it? So in case of other IFOS income, all the revenue expenses are allowed. In case of other IFOS income, all revenue expenses are allowed. Right? But please remember, from casual income, there is no deduction available. Let's say you have won a lottery of rupees 1 lakh and you have spent 10,000 rupees on the lottery ticket. So will your income is 90,000 rupees? No. Entirely 1 lakh. There is no deduction allowed from casual income. So from casual income, no deduction is allowed. Right? Section 58 is easy. 58 is similar to PGBP expenses which are not allowed. So if it is any capital expenses, it is not allowed. Any personal expenses which is not allowed. You have made a payment of more than 10,000 rupees in a single day to a single party in cash or a non-prescribed mode, bearer check or cross check, it is not allowed. Only banking mode is allowed. Right? If you have made a payment to a related party, it should not be more than the fair market value. If you have made a payment outside India without deducting TDS, 100% will be disallowed. If you have made a payment within India to a resident, 30% will be disallowed. Section 58 is similar to PGPP. 59, it will not come. But what is 59 is actually deemed IFOS. It is similar to section 41. 41 is deemed PGPP. It is deemed IFOS. So if there is any expenses which are claimed earlier and now you have recovered it, it will become your IFOS income. Simple. Section 222. And in fact, the last section is the most important. This last one is most important, 222E. Whenever there is a private company, unlisted company, the company in which public is not substantially interested, a closely held company. So I'm using the word private company, closely held company, the company in which public is not substantially interested. I'm talking about only for those companies. So let's say your examiner will give you ABC Private Limited, etc., or unlisted company. So whenever there are some private unlisted companies, etc., and any shareholder who has 10% or more equity shares, 10% or more voting right shares, that is equity shares, they take a loan from that company. It will become their dividend income up to the extent of accumulated profit. So it will become their income as a deemed dividend under section 222. Please remember, this is an important section. Correct. Agriculture income, if it is earned within from Indian lands, it is exempt. But if it is earned from outside India, it will be taxable. It will be taxable for ordinary resident. It will be 100% be taxable. Global income is taxable. For non-ordinary or for non-resident, it will be taxable if it is received in India, right? Because we understand that it is outside income. So for non-resident, they will say, why I will be going to pay tax? Only when if it is received in India. But I would like to mention over here that agriculture income from outside India will be taxable, right? Some received under LIC. So whenever you received uh, amount on maturity, etc., on LIC, then it should be generally it is exempt. It is exempt under section 1010D. But generally it is exempt. But sometimes if it would be taxable. If it is a high premium policy. Now, what is a high premium policy? So you should remember this date, 1st April 2012. Just remember this date, 1st April 2012. Right. So if the policy date is before this date, then what is a high premium policy where the premium amount, the annual premium is more than 20% of the sum assured. So if it is 20% of the sum assured, it's a high premium policy, and whenever the amount is received, it would be taxable. So 20% for next 1 year from April 12 to 31st March 2023, we will take 10% for all policies. But after 1 year, they have changed it. For physically handicapped, etc., they have taken it 15%, and for others, it is 10%. So generally, it is 10%, but for disabled, physically handicapped, etc., 15%. So if the premium is more than this percentage, 10%, 15%, or 20%, as the case may be, then it is a high premium policy. So whenever you receive the amount on this high premium policy, that is a taxable amount, right? And now in this year, they have made a little amendment also. If the policy date is in this year, that is from 1st April 2023, they have made an amendment also. If the premium is more than 10%, 15%, or 5 lakh, even if it is more than 5 lakh rupees, now they have made a limit, monetary limit also 5 lakh rupees. If it is more than 5 lakh rupees, then also it would be a taxable policy. It will be treated as a high premium policy. Okay. Next chapter is clubbing of income. See, clubbing of income, we all know that whenever the income is transferred without transfer of asset, then it will be clubbed in the hands of the transferor. Whenever the income is transferred without transfer of, you are not transferring asset, but you are just transferring your income, it will be taxable back in the hands of transferor. If the assets are transferred on a revocable basis, you can take back the asset anytime. It will be again be clubbing provisions would be applicable. But the most important are provisions related to spouse, provision related to minor child. Okay, let me first discuss with for minor child. See, provisions related to minor child. So any income of a minor child, including minor married daughter, any income of the minor child, including minor married daughter, will be clubbed in the hands of the parent. Which parent whose income before such clubbing is higher? So either it would be father or it would be mother. And once this clubbing is done, in subsequent years, we will not take the level of income. In subsequent year also, it will be clubbed in the same hands. Let's say in the first year it was clubbed in the hands of mother. So second year also it will be clubbed in the hands of mother only, right? It will be in second year, third year, etc. If the income of father is also more, then it is clubbed in the hands of mother, then it will be clubbed in the hands of mother only unless and until AO changes it. Correct? Second thing is there are certain cases when the minor income is not taxable. So there are certain cases which is very important where minor income is not taxable. If the minor is earning income from manual labor, it would not. Manual labor, skill, knowledge, etc., it would not be taxable. Or the minor child is physically handicapped. In that case, also it will not be clubbed. So, in case of minor labor or specialized knowledge, it will not be clubbed. It will be taxable only in the hands of minor child only. Correct. Now, if the minor child income is clubbed in the hands of parent, if the assessee is following optional regime, then 1500, whenever the income is clubbed in the hands of the parent, there would be a exemption of 1500 per child. 1500 per child. 1500 is a flat deduction. The amount of income clubbed of 1500, obviously, whichever is lower, up to 1500, you will get the exemption. But if the assessee is following default regime, there is no such exemption. Got it? Next, if the provisions related to spouse, if the spouse is earning any income, if the spouse is earning any remuneration, from such concern, she is getting salary, etc. She is getting any remuneration from such business where the other spouse has substantial interest, 20% or more. He has the ownership in that business of 20% or more, and their spouse is earning any remuneration without any professional qualification, experience, knowledge, or skill, then this income would be clubbed in the hands of the that person who has substantial interest. Got it? It will be clubbed in the hands of that person who has substantial interest. Under which head? Under the head salary. Because what is clubbing actually? See, clubbing is that it should be clubbed. The nature of the income should be the same because it was getting first of all it was getting tax in the hands of that person who is earning income, but now we are applying the provisions of clubbing, so we will take this income back in the hands of the transferor. So it should be go in the same hat to which this income belongs. So if it's a house property income, it will go in house property. If it's capital gain income, it will go in capital gain, and if it's a salary income, it will go in salary also. And yes, standard deduction would also be available, right? Whether the losses can also be clubbed, yes, losses can also be clubbed. So coming back, so if the remuneration of the spouse without any qualification, skill, or experience, if they are received, if they have qualification, experience, or skill, then it's okay. But if they don't have qualification, experience, or skill, then it will be clubbed in the hands of that particular person who has substantial interest. In case both husband and wife have substantial interest, so it will be clubbed in the hands of that person whose total income before such clubbing is higher. Got it? Asset transfer to a spouse. So if an individual transfer any asset to the spouse without consideration or inadequate consideration, if they transfer it to the spouse, then whatever the income which the spouse is generating on that asset, it will be clubbed. So whatever the income the spouse is generating on that asset, it will be clubbed in the hands of individual. Got it? But let's say debentures are transferred, and on that the spouse is earning 1 lakh rupees of interest. So 1 lakh would be clubbed in the hands of transfer. Let's say the has invested this 1 lakh rupees again somewhere, and she is earning 8,000 rupees income on that income. What it is? This is income on clubbed income. This is 8,000 rupees is income on clubbed income. Income on clubbed income will not be clubbed. Got it? Are you able to remember this provision? Income on clubbed income will not be clubbed. Next point. If we have transferred any asset and the spouse has changed this asset, then also it doesn't matter. Whatever the income on the changed asset, that will also be clubbed. Another important point, if we have transferred the house property, in the name of spouse, then there would be no clubbing. Why? Because as per section 27, in that case, the transferor would be the deemed owner only. So there is no requirement of clubbing because anyways, it will be taxable in the hands of the deemed owner, right? In that case, clubbing provisions will not apply. So if any asset is transferred other than house property, clubbing will apply. If it is house property, then clubbing is not required, then the transferor will be taxable prima facie. Got it? So there is no requirement of clubbing in that case. And yes, if it is important whenever the asset is transferred, there should be a relationship of husband and wife. And when the income is also accruing, there should be a relationship of husband and wife. It means that, let's say, if there is a divorce or living apart case, in that case, there would be no clubbing, right? If we have invested the money in the spouse business, if we have invested the money in the spouse business, then whatever is the profit which that business is generating, some portion also would be clubbed. So it depends which portion would be clubbed. So whatever the profit which we have earning from that business, you have to see what is the capital invested by the individual as on first day of the previous year. First day, that is 1st April of the previous year, divided by total capital of the business as on the first day of the previous year. So in this proportion, this profit will be clubbed. If on the first day the individual has not invested anything, let's say he has invested in 2nd April, 3rd April, etc. So in first year there would be no clubbing. Because why? Because on the first day there was no capital, the amount invested by the individual. So you have to see on 1st April, let's say this is 2023-24. So on 1st April 2023, how much was the amount invested by the individual? So please do it accordingly. So these are the provisions related to clubbing. This is not that important, but what it is, whenever an individual transfer his property to the HUF, right? So whatever the income which the HUF is earning, it will be again be clubbed in the hands of that individual member only. Because it was individual member property and he is transferring it to the HUF, it will be clubbed in the hands of that person only, not important. Let us come to the next chapter, set off and carry forward of losses. Set off and carry forward of losses. See, first of all, intra-head set off. Intra-head means same head set off. So if there is a loss in one head, it would be first set off from the same head itself. So in salary, we can't have a loss. In house property, we can have a loss. In house property, we can have a loss. So intra-head means house property 1, house property 2. Can house property 1 loss can be set off from house property 2? Yes. Up to which limit? Within head, there is no limit. Whether the asset is following optional regime or default regime, there is no problem. Within head, there is no problem. When we will be setting it house property loss, when we'll be setting it off from other head, then I'll be telling you that there is a difference in optional regime and default regime. But within the same head, there is no issue and there is no limit at all, right? Under both the regimes. So salary, there could be no loss. House property loss within same head, it is possible. PGBP within same head, it is possible. But if the person is having a loss under speculation business loss can be set off only from speculation business profits, or specified business losses. 14 businesses losses can be set off only from specified business only. But yes, normal business loss, which is not speculative, non-specified, right? Normal business losses can be set off from any of the business, even speculative also and specified also. But speculative losses, specified business losses cannot be set off from others, right? Capital gain, short-term capital gain can be set off from short-term also, long-term also. Long-term would be from long-term. IFOS generally we don't have a loss, but only in the case of owning and maintaining of horse races, that can be set off only from owning and maintaining horse races only, nowhere else. Got it? So this is intra-head set off. Inter-head set off. Can we set off the losses from other heads? The answer is yes, we can set off, right? We can set off from other heads also. Salary, we don't have a loss. In house property, it is important. House property. So it is important that whether you are following optional regime or you are following default regime, right? In case you are following default regime, in case default regime is followed, house property losses cannot be set off from other heads. It can be only be set off from same head, but it cannot be set off from other heads. Got it? So in default regime, please don't make a mistake. House property losses cannot be set off from other heads. In that case, it will be carried forward only. In that case, it will be only carried forward. Got it? In optional regime, house property losses can be set off from other heads also, maximum 2 lakh. Maximum 2 lakh, not more than 2 lakh. So in optional regime, you can set off house property losses from other heads, maximum 2 lakh. Correct? Third, PGBP. PGBP losses can be set off from any other head other than salary. Of course, we cannot set off anything from casual income. Casual income, you can not set off anything. But yes, that is for sure, that is universal. But PGBP losses cannot be set off from salary. Other than that, PGBP losses can be set off from house property. It can be set off from capital gain. It can be set off from IFOS also. No issues. But If it is, we understand if it is speculative or specified, they have restriction in the same head. So how they can be set off from other heads? So speculative business losses cannot be set off from any other head. Specified business losses cannot be set off from any other head. It is only for specified business only. Speculative from speculative. Got it? Capital losses, capital gain losses cannot be set off from other heads. Capital gain losses cannot be set off from other heads. Owning and maintaining resources also cannot be set off from any other head. It would be set off only from owning and maintaining resources only. That's it. Right. Now, first you will be doing the set off. First you will be doing the set off. Once set off is done, then if you are not able to set off, then it will be carried forward. Please remember a thumb rule. Please remember a thumb rule that whenever the losses are carried forward to next year, that is called brought forward losses. So whenever these losses are carried forward to next year, it will be set off from same head. They cannot be set off from any other head. Got it? So whenever the losses are carried forward to another year, it will be set off from same head only. House property will go to house property, PGV will go to PGVP, capital gain would be going to capital gain only, IFOS owning and maintaining will be going to owning and maintaining resources only. It cannot be set off from other head. So we know that PGV losses can be set off from any head other than salary. That is called set off. But when it is carried forward, to next year, it will be set off from PGBP only. Got it? Okay. House property. House property can be set off from house property only, and maximum it can be carried forward for 8 years. Right. In this case, please remember in house property and unabsorbed depreciation, even if the return is filed late, even then also house property losses can be carried forward. Unabsorbed depreciation can be carried forward even if the return is filed late. But PGBP losses, capital gain losses, or owning and maintaining resources can only be carried forward if the return is filed on time. If the return is filed up to the due date, then only it can be carried forward. PGBP losses, capital gain losses, or owning and maintaining resources. Got it? So if the return is filed late, you cannot carry it forward. Now, PGBP losses can be carried forward for 8 years, provided you have filed the return on time. Specified business losses can be set off for unlimited years. They can be carried forward for unlimited years. Speculative only for 4 years. Speculative only for 4 years. Capital gain losses can be carried forward for maximum 8 years, provided you have filed the return on time. Maximum 8 years. Generally, it is 8 years. For speculative, it is 4 years. For specified, it is unlimited years. Owning and maintaining resources, 4 years. Got it? So this is related to carry forward of losses. Got it? So please remember, it is an important chapter. Set off and carry forward is an important chapter. First, always, whenever you get the question, and always you get the question almost every now and then you get the question. So whenever you get the question, always, first of all, in your question, please try to do the current year losses. First of all, set the current year losses. Once everything is done for current year, then you have to see whatever is the brought forward. So please also remember that any brought forward losses you are setting it off, just check the expiry also. Just check the expiry also. If that loss is already expired, it is 8 years, 4 years as the case may be, then you cannot set it off. Got it? This was regarding set off. So now we'll be starting with deductions in our next